Well, Credit Suisse was a middling investment bank, and we don't like investment bank structures because they tend to have more variable earnings, and the earnings had been very poor. But more specifically, Credit Suisse was prone to negative shocks, like whether it be Greensill or Archegos or Mozambique. There are actually 15 of these that we were monitoring. So we had a ban on investments in the Credit Suisse holdco structure as early as May 2020, and we're advising our clients in February 21 to exit their exposures with Credit Suisse. Now, with respect to the short position, like in 2022, we were negative credit spreads more broadly. It was our view on the direction of interest rates relative to the markets. And Credit Suisse was one of the 10 billion worth of shorts we made at the time. But it is worth mentioning we were not involved in the speculative short-selling attack on Credit Suisse in March 2023. I mean, we did tell our investors that Credit Suisse would be targeted after the Silicon Valley Bank and hedge funds would turn their attention to Deutsche Bank. But Credit Suisse didn't deserve to die from a digital deposit run. If Swiss authorities had been quicker, to provide support to guarantee deposits as they did in the US, Credit Suisse would most likely still be around today. And the counterfactual is Deutsche Bank. I mean, rather than shorting Deutsche Bank, we're in contact with senior management. We were writing in financial press in Europe about what was required from the governments and the regulators to stabilise the situation. And when the German Chancellor signalled that they'd be protecting their national champion, at the same time as European regulators announced that they'd be investigating Credit Suisse and Deutsche Bank security transactions for market manipulation, well, the result of Deutsche Bank was very different. Now, there were some Aussie investors who were allocating to Credit Suisse hybrids, whether it be as a diversification play or as an attractive high-yield investment, but this wasn't our analysis. Well, on the night of the acquisition, when the acquisition was announced, the UBS Holdco senior bonds were trading 350 basis points above bonds. Now, this was equivalent to where major bank subordinated hybrids were trading. Look, there's many ways to present the numbers, but UBS was paying $3 billion for a business whose domestic Swiss banking unit was worth more than 3 times this. And the transaction was good for both equity and credit. I mean, it removed their number one competitor. They became the undisputed monopoly provider of wealth management in Switzerland, number 2 globally. It was actually 7 to 10 years of organic growth in one hit. They received emergency liquidity support from the central bank, loss-bearing agreements from the government. But UBS actually had quite a good track record in stabilising banking operations post the GFC. So on the night of the transaction, we were buying UBS senior bonds, and we bought 600 million over the next 3 sessions. Well, Aussie banks aren't investment banks. I mean, just simply like 80 to 85% of Aussie bank businesses is taking deposits and making loans. And this is only 25% of the Credit Suisse business. And Aussie banks are actually regarded as some of the safest in the world. And APRA, like it or not, is one of the toughest regulators in the world. And one of the reasons is because Aussie banks are among the best capitalised globally. And the reason for this is they were forced to massively delever, to raise extra equity, to provide unquestionably strong capital, following the financial system inquiry in 2014. It can involve de-risking their business, unwinding vertical integration structures, offloading those non-core, investment banking, insurance, financial advice, wealth management businesses. It's to the point where Aussie banks tend to benefit from a flight to quality during periods of financial instability. Look, more broadly, the soft landing narrative continues to build, but we're more focused on the impact of the rapid increase in interest rates and the higher for longer rates. Look, there's no doubt that the economy received significant stimulus during the pandemic and the savings buffers grew, but the defaults are increasing. Like the ASIC, Australian insolvencies, are actually at the highest level since 2016. And the S&P global defaults are the same, ex the 2020 pandemic year. I mean, the numbers for August were actually the highest since 2009. So, and similar numbers for the EU and US bankruptcies. Look, more specifically, regulators have discouraged banks from lending to the high-risk borrowers since the GFC. So a lot of these borrowers are being forced to the unregulated non-bank sector. The concern is that none of these non-banks existed during the last genuine default cycle. The 1991 interest rate-led recession with 11% unemployment. And as we said, they're not regulated by APRA, And so the lending standards can be very different. One example is that regulated banks have to provide a 3% serviceability buffer to determine loan affordability, where some of the non-banks apply a 1% buffer, and they've been doing this for some time. And the results, they come through in the delinquency data. Another concern is with respect to zombies. Now, we've been tracking zombies since 2019. Now, the strict definition of a zombie is a firm which has an interest coverage ratio of less than 1 time for greater than 3 years, and the business has been in existence for greater than 10 years. Now, in the EU, US, UK and Australia, 10 to 15% of listed companies are zombies. In Australia, that's 14%. And those numbers were taken in February 22 before 3.25% of additional rate increases. Now, in terms of where zombies live, 20% of listed real estate firms, more than 20%, are zombie firms. So we're concerned there'll be a cleansing of those firms who are overly reliant on the zero interest rate environment. Look, year-to-date Australian construction insolvencies, they're double the next highest category. And APRA has been advising banks for decades that the most common killer of banks during downturns is exposure to commercial property and residential construction. Now, non-banks have been focusing on these areas that banks have avoided. Look, it's well known that during the pandemic, the Australian Tax Office had delayed its enforcement actions. Now, liquidators and bankruptcy trustees, what they're seeing now are those smaller SMEs, those smaller businesses, which arguably should have filed in the last couple of years. But what they're expecting and what they've seen before is the next stage. When you get those larger businesses, which have smaller businesses which rely on them, that's when you get the chain reaction. So these are some of the concerns we have for the unregulated non-bank lenders. Look, it's been a while. I've been doing this for 30 years. And it's been 15 years since we can say that, pleased to say that cash is again king. You just don't need to reach for risk to achieve decent yields. And those asset allocation decisions that were made between 2008 and 2022 were very different now. So we're bullish on liquid, high quality, investment grade credit. This is very clear when you look at the relative yields on cash versus equity versus bonds. We know that we can get term deposits greater than 5%. The equity dividend on the Australian All Ordinaries, fully franked, is 5.7%. But highly rated bank bonds are carrying interest rates of 6 to 7%. Look, it's hard to justify investing in commercial property when they're yielding the same levels as government bonds. I mean, these assets are illiquid, so the prices need to fall 22 to 35% to achieve that historic spread over the risk-free benchmark of 3 to 5%. And we are seeing inflows from asset allocators into higher quality investment-grade fixed income. Look, I mentioned earlier that some Australian investors were allocating to Credit Suisse hybrids, whether on the basis of diversification or illiquidity premium. It was similar during the pandemic with the Virgin Senior bonds, very popular Virgin Senior bonds, and both these investments were wiped out. At Coolabah, we're focused on avoiding endogenous credit risk and avoiding blind diversification by concentrating on the safest firms in the world.